Ladies and gentlemen, good day and welcome to IIFL Finance Limited Q2 FY24 earnings conference call. From the management team, we have with us Mr. Nirmal Jain, Managing Director, IIFL Finance Limited, Mr. Monu Ratra, CEO, IIFL Home Finance Limited, Mr. Venkatesh N, CEO, IIFL Samasta Finance Limited, and Mr. Kapish Jain, Chief Financial Officer, IIFL Finance Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kapish Jain. Thank you, and over to you, sir.
Thank you very much. Good afternoon, ladies and gentlemen. Thank you very much for joining us for the second quarter earnings call for the company. I would request Nirmal to just set the ball rolling and give a perspective on the current macro environment, more particularly for our businesses, and his outlook on how things look like from a business performance more in quarter two and strategy going forward. Nirmal, if you can start.
Thank you, Kapish. And good afternoon, everybody. So, as we know, globally growth is slowing down, and more steeply outside US and maybe few countries like India. And interest rates are expected to remain higher for longer. And in this environment, India stands out in very good shape and a sweet spot. So all macro parameters in India show healthy trends. Inflation is in control. Growth is holding up. Demand for credit is strong. Interest rate upward movement seems to have paused. Financial system is robust. Tax collection is buoyant. Infra and capex cycle is seeing tremendous growth. And services in general are also doing very well too. So coming to IIFL, there is no change as such in our strategy. So we remain focused on retail lending, and that too targeting customers underbanked and geographies underpenetrated by banks. And that's why we make such good partners with banks for co-lending and sale of our priority sector and small ticket retail assets. Only one bit of change or move in our strategic direction, and that is our maybe the need and therefore our resolve to accelerate investment in digital technology and artificial intelligence or AI. We are poised to make some rapid strides in leveraging technological capabilities and digital capabilities riding on one hand, unmet digital infrastructure that has been created by the Government of India and exponential growth in artificial intelligence and machine learning. Our AUM crossed 73,000 crore mark in this quarter, and we are on track towards our guided AUM of rupees 1 lakh crore by end of next financial year. ROE is close to 4% and ROE has been above 20%. Gold loan, home loan, LAP, all these core loan assets grew by about 5 to 7% in the quarter-over-quarter. Digital loans grew at a faster pace on a small base, and similarly, microfinance also witnessed a very strong growth in line with the sector trend. Interest yield has improved across asset categories, again in line with the market trend. But contrary to market trends, we've been able to contain and keep our cost of funds stable. In fact, bring down by 10 basis points, benefiting from low-cost funding from multilateral agencies and National Housing Bank for refinance, for affordable and housing for economically weaker sections. Also, the full impact of repayment of high-cost dollar bond that we did last quarter, we saw in this quarter, and our improved credibility with banks and other institutional lenders, which give us leverage to negotiate our rates. With our time-tested strong underwriting standards and collection process, asset quality has improved across the board again, with the exception of gold loan, where despite reported numbers being a shade higher, the actual losses or actual risk of loss is very minimal. We are taking shareholders' approval for capital raise anytime during the next 1 year and enabling resolution to tap the capital market at appropriate time. With this, I hand over to Kapish to take you through the financial numbers in greater detail. Thank you.
Thanks a lot, Nirmal. So before we go ahead for the Q&A, I will just give a highlight and a snapshot of how our performance has been for the quarter. So for the quarter, IIFL Finance at a consolidated level before non-controlling minority adjustment was 525 crore, which is up 32% YOY and up 11% on a quarter-on-quarter basis. We recorded a pre-provision operating profit of around 922 crores for the quarter, up by 41% YOY and 16% on a Q-on-Q basis. For the quarter, our consolidated loan AUM grew by 32% to 73,000 crore. On a YOY basis, this reports a growth of 32% and 7% on a Q-on-Q. Further dissecting the AUM, our core products of the loan AUM is driven by gold, housing finance, and microfinance. And then the growth here has been around 34% YOY and 7% Q-on-Q from 69,744. This largely comprises of all our retail portfolio and currently now comprises of 95% of our total AUM. As highlighted by Nirmal, our gross NPA stood at around 1.8%, and which is still marginally lower than our guidance to the market of around 2%. And our net NPA is around 1%, which is significantly lower and down by 58 basis points and 20 basis points respectively when compared to the same period last year. With the implementation of the expected credit loss under IIS, the provision coverage ratio on NPA stands at around 159%. In continuation of our capital optimization strategy, 40% of our AUM is either assigned or under co-lending arrangements with financial institutions as of 30th of September 2023. And going forward, we will see a larger share of co-lending emerging in December, like what we have highlighted in the previous quarters. The assigned loan book therefore stands at around 18,429, which is up by 19% YOY and 4% Q-on-Q. And more particularly, the co-lending asset book crosses a critical milestone of 10,000 crore and stands at around 10,576, which is 125% up YOY and 18% on a Q-on-Q basis. In spite of the rising interest rate scenarios in the last 1 year, where we saw cost in MCLRs and the bank repo ranging from around 150 to 250 basis points, with a more dynamic operations, we could get our cost of borrowing, got a muted growth of around 40 basis points YOY, and sequentially it went down by around 6 basis points, led by some of the multilateral borrowing that we did, and we also got a very lumpy chunk of borrowing that we could get from the National Housing Bank in a housing finance company. Not to mention the high cost MTN borrowing that we paid off last quarter, which had a full impact this quarter as well. From a liquidity perspective, we are fairly healthy. We stand at a liquidity of around 9,000 crore, 9,078 crore to be precise. And during this quarter, we raised around 5,502 crore through a mix of term loans, bonds, and refinance, and 4,288 crore was done through direct assignments of loans to various banks. As I mentioned, some of the key highlights of our borrowing this quarter has been a 50 million of borrowing that we did from U.S. International Development Financial Corporation for financing affordable housing loans, and 100 million from IFC World Bank, with 50% earmarked to promote women borrowers and 50% towards green housing under the underserved category, and around 1,500 crore that we have already drawn from the National Housing Bank. We have a positive ALM whereby inflows cover exceeds and the expected outflows across all our buckets, and with the net gearing at a healthy position at around 3.3x. Our annualized ROE for this quarter is around 8.1%, supported by a healthy ROA of around 3.9, which moves up our earnings per share to around 12.5 for the quarter, up 25% YOY and 11% on a quarter-on-quarter basis. Our capital adequacy stands firm at around 20.5 for the housing finance company. HFC, supported by the capital infusion that we got, it stands at around 47.6, and Samasta is 21%. Our CRR is of course well above the minimum threshold requirement of 15%, clearly suggesting that we are able to grow ourselves without impacting hugely on the capital position through the on-book, off-book strategy which has been holding for us well. And not to mention the healthy internal accrual which is coming from the NIM which we have been able to maintain over the last few quarters. With this, I open the floor for question and answers, ladies and gentlemen, and thank you very much.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Shweta Daptardar from Elara Capital. Please go ahead.
Thank you, sir, for the opportunity and congratulations for great set of numbers. I have a couple of questions. One is, for most of the NBFC managements, I have been calling out concerns on small ticket lending or personal loan segments. You being, Mr. Jain, you being a veteran, what are your inputs, especially in light of IIFL Finance portfolio on the digital loan for finance side? That's question number one.
Yeah. So I think personal loan, maybe the fears are not completely unfounded because there has been very aggressive personal loan portfolio built up by some of the new fintechs and new NBFCs, and banks have to become aggressive. But banks probably will have more established credit underwriting practices. As far as we are concerned, this is not a thrust product for growth. Our personal loan is more limited to our known customers as a cross-sell, but our digital loans are more focused on MSME and business loans. But in personal loans, I won't have the details, but many of the fintechs, the new practices for underwriting that they follow can have risk, and those risks manifest more in the down cycle and when the economic activity slows down. I'll be cautious.
Noted. My second question pertains specifically to gold loan portfolio. So how are the LTV, ticket size and customer segmentation working for us on the gold loan side? Have there been any shifts given the current market scenario? Thank you.
Not really. I think our gold loan portfolio and the customer profile, because there are millions of customers, they remain broadly the same. In terms of our average ticket size, there's a little increase, but that is, so which used to be say around 70,000 rupees last year, is around 73,800 rupees in the last quarter. So I mean that is basically inflation and the increase in gold prices, but broadly the target customer segment remains the same.
Noted. That's all from my side. Thank you.
Thank you.
Thank you. Next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah. Now,
Yes.
yeah. So the first question again, I have two questions. One on gold loans, the other one on home loans. Both pertains to strong growth that we're seeing in both the segments. Just wanted to understand first on gold loans, what would you attribute this strong momentum in gold loan growth? Is it predominantly the distribution that we have built, or would you kind of attribute it to the fact that you're also doing fair amount of co-lending in gold loans, which perhaps allows you to offer very attractively priced gold loans to customers despite being an NBFC? So if you could just help us understand that, while I mean checks seem to suggest that
I think gold loan growth in the gold loan asset is primarily driven by one, the distribution that we have built over the last 2-3 years, and two, are very customer centric and friendly practices that we have. I don't think that co-lending in any way helps, because in fact if you really notice, co-lending cost is higher than the cost of borrowing, so that doesn't allow us to price the product cheaper. And in fact it's primarily because of the distribution strength that we have built. So if you see the number of branches, then the way we have grown over the last 2-3 years has been very significant. In fact, more than 50-60% growth in number of branches alone. And still, if you look at our branch, our productivity per branch is around 8.5 crore compared to say 12 crores of the leading player in the industry. So it's more. I mean, I will say that the primary reason is the distribution that we have built over the years, and then the customer goodwill that we are building and getting repeat business also from the customer.
Got it, sir. So and a similar question on home loans as well. Different industry experts kind of seem to suggest that there is some slowdown that we're seeing in urban affordable housing, in ticket sizes between 15 to 25 lakhs, 15 to 30 lakhs thereabouts, some slowdown being seen. Different reasons being attributed. Some of them say that there is a supply constraint, which is there when the CLSS was withdrawn for the developer community. But if I kind of look at our home loan franchise, continues to do very well, continues to grow from strength to strength. I think it is predominantly because our business model, as I understand it, also leverages these developer APFs extensively, which most other, at least listed HFCs don't. Do you think that is a moat that we have kind of built in our home loan franchise today, which is helping us when there is a more of a narrative of a slowdown that we are seeing in smaller ticket mortgages?
Yeah, Abhijit. In fact, we have Monu, who is the CEO of our housing finance company. He's there on the call, then probably he can take this.
Yeah, thank you, Nirmal. Hi, Abhijit. So, Abhijit rightly said that we have been seeing the reports that in the metros and the hubs, there has been a constraint in the supply in the affordable housing. But if you look at our expansion of our distribution, which we have done in the last about 2 years' time, this is playing out to offset us any slowdown in the tier 1 and the metros. The constitution of our, which we call as expansion branches, as a percentage of the overall disbursement has monthly disbursement has increased. So whatever marginal slowdown we are seeing, which is absolutely correct, we have been able to offset by the distribution. If you will see the kind of manpower we have added and the distribution we have added, currently we are in presence in about 370 plus locations. So Abhijit, that is offsetting it. Secondly, as far as the APF thing is concerned, yes, we have decent relationships which continue to thrive, but majorly this growth continues because of our expansion branches, which we have worked on for the last 2 years, and we hope to see carry that momentum forward.
Well, this is useful, and just in the interest of time, one last question. Sir, I mean, when I look at Samasta, obviously growing at a very, very strong clip, I mean, do you think going forward you will kind of look to slow down here, or are we still looking at close to 50% kind of a bio growth for the next 2 years?
I think maybe for a year or two it may continue at that pace. In fact, in the COVID, the things have slowed down, so there was a bit of a catching up with the natural trend line. But as the base becomes larger, the growth will slow down in percentage terms.
Got it. This is very, very useful. Congratulations and all the best.
Thank you. Thanks, Sanjeev.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Anusha Raheja from the Dalal & Broacha. Please go ahead.
Yeah, thanks for taking my question and congrats on good set of numbers. Firstly, you said that you might require a capital over the next 1 year's time. So that is for the subsidiary or for the parent company?
So the approval that we have taken is for the parent company, and in the subsidiary we can, housing finance, we have raised private equity. So we have both the options available. We can actually raise capital either in parent or microfinance and or both, but that way in terms of our gearing, in terms of our capital adequacy, we are fairly comfortable. So we'll have to wait for the opportune time. Otherwise, we can wait. We don't have any pressure to raise capital in terms of requirement of capital for growth. We can grow with the current capital as well.
Okay. So the requirement is more specifically from the, for the parent and for MFI, because I think
because housing finance we raise capital from ADIA, and still our capital adequacy is very high, is around 40-45% or so. So that's more than adequate for next few years. Yeah.
Mm-hmm. Yeah. And secondly, on the gold loan NPLs, if I see there is a sequential rise there to 1.2% odd levels. So what explains that?
So gold loan, in fact, gold jewelry and ornaments, they are emotional assets of the customer, and we generally are very careful before we just put them into auction. Or so even when the NPA and the customers are regular, sometimes if the gold prices have fallen, customers may take some time. So we just put up with that. But historically, if you see, the loss given default in this asset class has been minimal or negligible. And I think it's a festive season in this quarter, and many people release the jewelry. So, I mean, it's a small temporary aberration, but I don't see any risk in terms of the product class.
Okay. And what was the NHB borrowing during the quarter? I missed on to that number.
Borrowing?
NHB borrowings?
No. So, okay, what we are saying is that if you look at our cost of funding on an average has come down by 10 basis points in the quarter, and primarily because we get a low-cost funding for our affordable housing and the economically weaker section housing finance that we do. So there's a refinance from National Housing Bank, NHB, where the interest rate depends on what kind of customers we are lending to. So that has been at a lower rate, and similarly we got some funding which is at a consistent rate from multilateral agencies. Hello? Yeah, so that has basically helped us control the cost of funds. Okay.
So, so far I think this quarter we have managed the margins quite well. I mean, contrary to other NBFCs where, they are facing the margin contraction. What is the outlook, say over the next 2 quarters? How do we see, margins panning out?
So, actually we have focused only on primarily four, which is mortgages, MSME lending, and gold loans and microfinance. So, in all these, and affordable housing, affordable home loans, a significant part of mortgages, we have the power, I mean, we have the pricing power in the sense that market is not so sensitive to interest rate. I mean, we are typically able to pass on the increase in interest rate that happens systematically. And on the other hand, in the last few years, we have been able to improve our financial position, our credibility through the cycle, and also the high-cost dollar bond that we had, which were raised during the times of COVID, we are repaid. So, going forward, I think we should be able to maintain our margins. Our NIM will remain at around 7.5% or thereabout, yeah.
Yeah. And just lastly, on the growth side, so far we have seen a quite, strong growth across segments like home loans, gold loans, and on the MFI side. See, over the next 1 to 2 years, are you seeing on the ground level any slowdown in any of the segments, or whether growth is a concern, or you would prefer to grow at a slower rate, or you feel that, the current momentum, can continue?
So as of now, the demand for credit is very strong, and India is still a grossly under-penetrated market in terms of credit to small businesses as well as, the retail customers. So at this point in time, I think the momentum for credit demand is strong and the growth trajectory will continue. Having said this, I'll caution on a couple of things. If the economic activity slows down, or if you see some significant pressure on the interest rate, which can happen for multiple reasons, then, one has to be cautious for that. But other than that, if the economy remains strong the way it is today, then I don't see any slowdown in the demand.
Okay. Got it. Thanks.
Thank you. Thank you, Anusha.
Thank you. Next question is from the line of Renish from ICICI Bank. Please go ahead.
Yeah, hi. Sir, just 2 questions. One is on your IIFL standalone profitability. So, if we look at the first half 24 ROE, ROA, or in fact in the absolute fact number, that is being far lower than what we have reported in 22 and 23. So, what explains that profitability hit in first half, sir?
So, in standalone, one is that we have actually, you would have noticed that we have moved significantly from direct assignment where the excess income or excess interest used to be capitalized to co-lending. And if you see our co-lending book has crossed 10,000 crore milestone in this quarter, which is very significant. So I think this, when you compare the last year, there's a significant component of upfronted assignment income. And on the other hand, co-lending book, as it keeps building up, you see the co-lending interest income also keeps growing.
Right.
So Sorry?
Okay, so it is fair to assume that, let's say, a shift from a direct assignment to co-lending is actually hitting the profitability at standalone entity level?
Yeah. And see, another thing that happens in a direct assignment many times, if the assets get repaid faster, then obviously you have to take the upfronted income as a reversal also. So, but what you are saying is right. The primary reason is that co-lending is basically taking over. So it's a transition phase. And secondly, because of digital finance and one account in our CRE being restructured, the provisions are higher.
Okay. Got it. And sir, secondly, at the entity level, as well, if we look at the first non-fund based income this quarter, it has actually gone up by 23% sequentially. But when we look at the incremental assigned plus co-lending pool, that remains static at around 2,000 crore. So what explains that? I mean, it is fair to assume that because of the higher interest in some of the assigned portfolio, the spread on the assigned pool might have gone up this quarter.
One second. See, what is assigned income growth? The assigned book, assigned book also has grown slowly, but there's still a growth. But income from assigned assets, you're seeing quarter-over-quarter or why you're saying?
Quarter, sir.
Yeah, so the banks basically have a reset based on their MCLR. Just give me 1 minute.
Yeah, sure, sir.
Okay, sorry. And then this quarter we had an assignment in Samasta for the, Samasta normally we had not assigned earlier, but there was a loan assignment of Samasta this quarter.
Okay.
So what is happening? Still, the co-lending is, most banks are not willing to, but we are able to assign the assets.
Got it. So basically, this quarter we might have assigned higher under Samasta, which is a high yielding book. That's why there is a high non-fund based income. Is that right?
That's right. So in the Samasta, I think assignment will continue.
Got it. Okay. And sir, just last thing, at the Concall level, what should be the AUM growth over next couple of years we are factoring in?
25% is what we should, we have guided, and I think we should achieve that.
Okay. Thank you, Nirmal. Best of luck for the coming quarter.
Thanks.
Thank you. Next question is from the line of Abhishek from HSBC. Please go ahead.
Yeah, thank you. Hi, Nirmal. Thanks for taking my question. So just a few questions. First on MFI, when I look at the gross stage 3 assets, they have not gone up, but the credit costs have gone up, sequentially. So have there been any write-offs because of which the credit cost is higher?
Yes, there will be some write-offs in Samasta.
Can you quantify how much it was this quarter versus last quarter?
No, the provision has gone up because of, as the book grows, stage 1, stage 2 also has gone up. And the write-offs are 98 crores this quarter, which is 88 crores last quarter in Samasta. But the provision that you are seeing, because when the book grows, your stage 1, stage 2 provisions also grow significantly. Abhishek?
Of course. Yeah.
So I think that's why provisions are high.
Okay.
But there's a write-off increase of 10 crores also.
Exactly. That's the driver. Okay.
Absolutely.
And when I look at the yields, right, the data that you've given on the yields, in gold loan, the portfolio yield has gone up, I think, by about 1% in the quarter. So, can it be so sharp in just one quarter, or does this have any kind of one-off?
No, this is actually the gold loan portfolio churns very fast. The average life is 90 days, 120 days also. And the gold loan yield has started improving from quarter before last. So maybe we are seeing impact on this quarter. But I mean, I don't see another thing that happens in this is that the average book is little different from the quarter end book.
Okay.
So now I don't have those numbers with me, but when we reconcile with average book, then probably that will explain the story better.
So this yield is based on the average book.
So what happens? The yield that we give in the financial results is based on the quarter end. No, I think so. The yield difference. How much the yield difference in the quarter to quarter? 100 basis points. Yeah, yield has gone up as the market, the competition has yield has gone up. In gold loan, the impact can be quicker compared to the other asset classes where the assets are much longer term, like home loan. But in the gold loan, yield can move very fast.
So the yield hike was taken when in gold loans? The last?
Yield hike actually we started taking from April because in the last year, in the last 2 quarters, there was very intense competition from banks and from NBFCs. So this financial year, from April, we started taking, we got back to the normal rates of interest and we had quite a few teaser schemes and a low interest scheme that we withdrew in most of the places.
Got it. And can you share the tonnage for gold loans for this quarter and last quarter maybe?
Just 1 minute. What is the tonnage? There's a 6% tonnage growth and what is the tonnage increase? Is there in the data book this data? Yes, it is. Is there in data book, Abhishek, 63 tons now?
I'll pick it up. Thank you.
Yeah, it's there.
Sure. One last question on cost of borrowing. So actually, 2 things. One, when do we see this cost of borrowing start showing the upward trend? Because the market rates are stiffer, you would have some back book repricing. So when does it start moving up?
I think we should be able to maintain at those 9%. I don't think my personal view is that the interest rates in India at least have paused and they peaked out. I mean, they may not fall, but they might remain at these levels. In that situation, I think we should be able to maintain at the current level. 10 basis points here and there, it can move around, but not beyond that.
Got it. Thank you so much, Nirmal, and congratulations for all the best. Thank you.
Thank you. Next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
And congrats for a great set of results.
Thank you, Nischint.
So first question is, on the operating expenses line, if I really look at your loan growth, you've been growing fastest in microfinance and probably followed by gold loans. Now, both these businesses have lower tickets and in that sense tend to be sort of slightly more OPEX intensive. And probably, home loans and the wholesale businesses are lower OPEX. But I think despite that, your OPEX growth is lower than the loan growth. So you seem to be kind of, getting some benefit from there. So just trying to understand what's happening here.
So, Nischint, we have slowed down the growth in our branches. So significant part of OPEX comes when you are setting up new branches. So if you really look at, we are driving our growth by making our existing branches more productive and taking the productivity of a branch up as much as possible. And also with our digital loan business is primarily end-to-end digital, and there the manpower requirement is lower. In fact, OPEX is still at a much higher level, and we have maybe room for savings over the next few quarters. In terms of OPEX or cost-to-income ratio, because as I said, that if you look at our gold loan branch productivity, 8.5 crore, there is a leading player at 22 crore. Now, there is a very significant difference. If we keep the branches at our, whatever we have, so the same set of people, same set of branches, if they can originate more assets and build up, then obviously our OPEX should come down.
But microfinance, practically, I guess the geographies would be different, right? So you can't share branches. Gold loan again, sort of.
No, even in microfinance, we have 1,100, 1,200 branches. So there's also network which we expanded in the recent time. So if you look at our manpower cost on a quarter-to-quarter basis, what is the manpower cost? That has gone up actually. And there will be some savings in our other costs, which is total OpEx. Just give me 1 second.
427 crores for the quarter.
So manpower cost has gone up from 384 to 427. Operating cost also has gone up by 7% in the quarter, which is very significant. And that is primarily because we are expanding the microfinance network.
The other expenses, which is ex of employment depreciation, it's up around 15%, which is like less than half the overall loan growth. So, that's I think where my question was.
No, that is basically because the new branches are not being set up. But the existing branches, we add people, and so the new branch addition has been very minimal.
On the digital loans side, I mean, this is a small business, but growing very rapidly. So what is the tenure of these loans?
Now, tenure of this loan varies from 6 months to 2 years, typically.
The NPLs in this book, and I think the ratios may not be very accurate representation because, it's been growing very fast. But over the last 6 months, the NPA in this book has grown by almost like 25%. So, and I would believe that 6 months lag ratio is a fair ratio to look at, given the fact that probably somebody may not default in 3 months, and we have a 3-month NPA recognition. So, so are you kind of worried? Are you seeing, and you have been growing very fast. So, are you kind of seeing any concerning signs because of which you would slow down? It's a small proportion of the book, so it matters less, but nevertheless, it's it's a very fast.
Well, you're right. So if you see our stage 3 provision in this is 73%. So what we are trying to understand, our strategy here is that the risk is priced in because the interest rate also is higher on these kind of loans. And we are prepared that through the cycles, and as books mature, there can be higher losses. So we want to keep aggressively providing for it. But even risk-adjusted return is quite attractive.
How it appears, your sense is that you will continue to grow this rapidly.
We'll continue to grow. At this base, it will grow faster. When the base becomes larger, the growth may slow down. And the GNPAs and NPAs in this book will be higher than the rest of our other loan books. And that we price, as we go, to the customer.
It's native in-house, right? There are no partnerships in this.
No, we have partnerships to source. We don't, and we have a few partnerships, but a significant part of business is organic. So we do have partnerships, including Airtel and GPay and others also. But by and large, business is, many partnerships are for lead. There are very few partnerships where the loan is sourced as such. So our primary partnerships or our focus for growth is to have digital partnerships that we can get lead and we pay a fee. But we do underwriting and we take the risk.
Hopefully originated, let's say, by a partner, and that is kind of picked up by you. It's something that they just pass on the.
What happens in partnership model is that there are one of the small partnerships that we have, which is an FLDG. But there, normally your interest rate and your income is also capped. So many of the players that have done partnership, they might give 15%, 16%, and then a bit of a first loss. But our strategy is that we want to have full access to data. So we do underwriting, we keep learning, and we have full control on the credit quality as well as who we are lending to.
On the yield side, your home loan yield is marginally down on a sequential basis. So, so is there anything that you should be reading?
Modu, you want to respond to this?
Hello? Yeah.
Modu, this is asking.
Yeah, I saw that. So it's a very, very marginal change. It's, I think if you just look at it, it's a pretty marginal change, and it's primarily to do that how where we are playing out, how the areas are panning out. So there is nothing very significant in the yield change if you see. Rather, the portfolio yield has a shade gone up only.
It's 11.2 to 11% in the quarter-over-quarter. Yeah. But this 11.2 was also a bit on the higher side because historically it has been 10.5%. So I think we've already a bit of tapering off this quarter.
Yeah.
Cut rates in any cohorts, or is it just competition that is driving?
There's nothing in the cohorts, but it's just the competition which is played out a bit.
Yeah. This is a competitive segment of the business.
Segment to be in. Otherwise, also overall, I think 11% is pretty much okay, in line with our strategy.
Collaborates with, I think, the general industry view. Just on the lab side, interestingly, the trend is very different. Your pricing power seems to be pretty strong.
Yeah.
Although, so is it something that is a very different segment? I guess the ticket size. I mean, how should one really think of it? Because that was also a reasonably competitive segment.
Yes. So for the last about 2 years, like primarily earlier, we were been focusing on lab only in our hub places, but as we had experience of expansion in branches, so for the last 2 years, we are doing a bit of lab business in our expansion branches, where the expected yields are better than the hub locations, which is a very competitive market if you try to give lab loans in the tier 1 and the metros. So the one which is we are able to source through the smaller towns, we have better yields.
But these lab yields is so this is in line with the industry. So even the competition will charge similar yield. And the primary reason is that this business has significant operating cost as well, and is not in terms of the physical collection of the installment as well as processing. And in smaller locations for a small ticket lab of 4-5 lakh rupees, 7-8 lakh rupees, the cost of title, valuation, everything is significant. So when the industry rates are also higher because there's the cost structure of this segment of business as well.
Final question, if I can, and that's on the microfinance side. On the microfinance side, there have been some concerns in the industry that delinquent customers tend to get refinanced by, basically get refinanced by finance companies, or they move from one company to the other. So I think in this regard, what is the policy that you follow at the moment?
Actually, delinquent customers. Credit score and they will be based. So all the customers in microfinance are reported to bureau. So this is what we like to. Venkatesh, you are there on call?
Yeah, Nirmal, I'm there on call. Yeah, with aspect to the policy in terms of our lending, we don't lend to any customer who's more than 30 DPD and who's got an outstanding of more than 4,000. See, a couple of companies don't report the credit bureau on a very daily basis. So we give them a leeway of 4,000 maximum, which could be one EMI in some ticket sizes. So ours is very restricted into that. We don't give to any customer more than 30
period, which means that if the customer has been an NPA, comes out of NPA, you would lend him after a particular period or something of that sort.
No. I'm talking about customer is not in an NPA. I'm talking about a regular customer.
That's right, but I'm saying that customers who sort of come out of an NPA, is there a pull-off period for redisbursement?
Yeah, that naturally applies. We also have a track record of, once we look at the credit bureau, we have a track record of the customer, and she's coming out of the NPA, we definitely will not lend.
Questions. All the best.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello, am I audible, sir?
Yes.
Yeah, sir, my question revolves around your ROA. I mean, now this quarter also we have seen a very good growth, and accordingly ROA is 3.9%. But what sort of sustainable or steady state or aspirational ROA as a business we are looking at going forward? Now, considering also because you told that your co-lending share will increase, right? So that will be ROA accretive. That's what I presume, yeah. So some color on it would be helpful, sir.
As what Nirmal mentioned, this is Kapish here. So if I can just pitch in, as Nirmal mentioned, in spite of the rising interest rate scenario, we have been able to pass on our rate hikes to our borrowers. Our spread across quarters have actually moved up. We have done our investments with regard to branch expansions, which means that there wouldn't be any more incremental investments coming in to meet the growth targets from our operating expenses perspective. All these attributes should help us in maintaining our overall NIMs, and with better optimization on our costs, we believe that we should be able to maintain our ROA in the range, which could be between 3.7 to 3.9, touching towards 4. So we believe that we should be able to maintain our ROA at the levels they are today.
Great.
And there could be some more spots as well there. Yeah.
I understood. And my second question is on your credit cost. I think ideally that could also help your ROA, because ideally your credit cost in the range of 2.25 to 2.5% is little on the higher side, right? I mean, considering the
it should be on a more longer term steady state basis should be within 2%. Yeah.
Within, why not below 1.5 to 1%?
That's right.
No. So I was trying to understand why it can't be below 1%. I mean, because of the NFI business that you expect.
Okay, I'll tell you what. Over a period of time, so microfinance business historically prior to COVID used to have much lower NPA, but now most of the industry people expect longer term credit cost in microfinance business to be around 2% or so. Similarly, in digital loan, it can be a little higher than 2% also. And what you are saying is right, that at least if you look at home loan and gold loan, it should be much lesser.
Absolutely.
But I think as things stabilize over a period of time, then again it depends on the relative share of the unsecured loans in microfinance and digital loan. But it can be lower. It should be lower than what, if not one, at least maybe closer to 1.5, 1.5.
Yeah, because that straight away adds 0.75% to your ROA, right?
Yes, it should.
So trajectory which is at 3.5 to 4% can inch towards 4.5% if our credit cost comes below or closer to the 1% mark. That
is there. But at the same time, Deepak, there will be little competitive pressure on the margins also over a period of time. So, what you're saying, in one scenario it can happen, and at least the credit cost should go down, and that should straight away add to the ROA. But there will be many other variables and there are many other moving parts.
Fair enough. I got the sense.
Yeah, great.
That's it
Thank
from my
you.
side. All the very best. Thank you.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask the question. Next question is from the line of Akriti Banka from HSBC Mutual Fund. Please go ahead.
Yeah, hi. Can you hear me?
Yes.
Yeah, hi. I just have one question. I think it's already addressed it. But how did your yields, how did you manage to increase yields in the gold book in this quarter?
So gold loan yield, across industry, I think would have improved because last year, quarter 3 and quarter 4, there was sort of, intense price war kind of a thing because some people started teaser and some larger players started following up. Many banks also got into this with a lower rate of interest. But I think many banks also now discover that if they do the separate profit and loss accounting of gold loan, then the operating cost is much higher. So it's not something which is, because when you are doing a 50,000, 60,000 rupees loan for a shorter tenure, then the cost is higher. So I think it is actually the yield is going back to the earlier level. The normal is getting normalized. In between there was an aberration, then the yield came down.
Okay. So you think there is still some scope for this to go up further, or
No, I think they've remained at these levels.
Because even I thought by Q1 itself, things had sort of normalized, which is when you were at 17.5, and this quarter is showing even higher than that.
Yeah, impact comes actually with a lag of 1 or 2 quarters actually, because as the earlier loans get repaid, because they are at a contracted rate which can be lower, so it always spreads out over a couple of quarters.
Got it. Okay, thanks. That's it.
Thank you.
Thank you. Next question is from the line of Jigar Jani from B&K Securities. Please go ahead.
I just wanted to quiz on the fundraising, although it's an underplaying provision. Now, considering we are moving largely off book, which is co-lending and DA, 40% is what we are at, I think, for that book, and we are guiding for 25% growth. I think then 60% of the 25% only needs to be funded through internal accruals or equity, because even if I consider the co-lending part of 20%, probably we push it to 17-18%. And we are already making kind of 20% ROEs overall, and we are expecting ROEs to remain stable. So won't this additional equity of 3,000 crores be a drag on your ROEs, whereas you can easily fund your estimated growth of 25% through internal accruals itself, considering we are moving more and more off book?
So, it's a good question, and but okay. So whether if you don't do this, then probably the ROE can move up further as our profit keeps adding to the pool. But as we are in a finance business where, from a rating agency point of view, from the banks that are partnering with you, they also want to see your balance sheet becoming stronger as your total assets grow. I mean, it's not necessary that we will raise 3,000 crores, we should up to 3,000 crores. But whatever equity addition happens, which can be to our net worth 20-30%, which maybe next 12 to 18 months we can catch up in terms of ROE. And that will also help us grow a little faster than what we've been doing till now.
Right. So there might be a chance that your growth trajectory might move higher post the equity fundraise. And any plans to go inorganic in terms of growth post this fundraise?
So we are open to opportunity, but it's not something which nothing is on the anvil or nothing is in the pipeline. But yeah, if there are good opportunities, we can always look at them.
Sure, understood. Thank you so much for answering the question.
Thank you.
Thank you.
Thank you. A reminder to all the participants, you may press star and one to ask a question. Next question is from the line of Adarsh from Enam Holdings. Please go ahead.
Hello. Yeah, thank you for taking my question. So broadly, if you can break up the assignment assets in the categories, and same for the co-origination, and can you explain the economics of both these routes, both for you and for your partner?
So assigned assets, we had 18,429 crores as on Q2 FY24, and co-lending is 10,576 crores. Most of these will be home loan and gold loan, but if you want to break up, just give me a minute. In around 2,300 MFI, or 11,500 in housing, including LAP, and 8,900 in gold. Okay. So roughly 7,500 is mortgage assets, 8,500 or so is gold, and the remaining is the microfinance in the assigned book. And the co-lending book, again, primarily is gold, LAP, and housing. Gold, LAP, and housing.
Good. So just from the co-lending book, can you just explain the economics, like how it
co-lending book, for every product like LAP, home loan, and gold loan, the interest which bank will retain is negotiated separately. Also based on the credit policies, the region and geography that we do. So supposing I'm doing the gold loan at say 16%, and I agree with bank as their share at say 9.5%. Then what happens that every quarter, whatever interest is approved, that comes into the escrow account, 9.5 goes to them, and the remaining comes to us. So that is about co-lending. In case of assignment, we take the total income, make an NPV based on the probability of that income accruing, reduce the cost of servicing from that, and that is upfronted.
Got it. This is helpful. Thanks.
Thank you, Adarsh.
Thank you. A reminder to all the participants, you may press star and one to ask a question. Next question is on the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Thanks for allowing me to follow. So, going back to the personal loans again, you yourself said that.
Sorry to interrupt you. Audio is not clear. Can you speak through the handset, please?
Is it better now?
Yes, sir. Thank you.
Yeah, thanks. So again, going back to the personal loans again, you yourself said that you kind of remain cautious in personal loans. While given the small base, if you kind of continue to grow strongly even from current levels. Just kind of trying to understand why the risk-adjusted returns are good, at least at an industry level. There have been discussions happening around small ticket personal loans where the ticket sizes are less than 50,000 rupees. Have you had a chance to see what proportion of your customers or what proportion of your digital loans have ticket sizes below 50,000?
Yeah. So below 50 now, no, okay. Personal loan is happening in all sizes, like the BNPL will be 5,000, 10,000, 3,000, 20,000, all kind of thing. So we'll have a reasonably good number of our loans less than 50,000, but primarily our loans are to self-employed professionals or the small shopkeepers, the businessmen, and the micro enterprises. I think the difference. Another thing is that even personal loan as a category, as an asset class, we can't paint it with one brush. There are many banks that do it very smartly, very cautiously. So when I said my worry is more about the new players where, they are still moving up on the learning curve in terms of credit underwriting, and they are trying to achieve aggressive growth. That is just the class of lenders or the segment of customers that they are targeting is more risky. And but the market is very big, and the type of loan that get categorized as personal loan again is very wide variety. But in our case, mostly now our focus, there can be a small part of it as a personal loan. Sometimes, people like sole proprietors, they run the entire thing through their personal account. So it becomes the blurred line between personal and business loan. But our focus for growth is more on MSME and business loans.
Got it.
I think the credit risk is different when people are borrowing for consumption and people are borrowing for business or income generating activity.
Understood. So just one follow-up here. I mean, have you seen any divergence in terms of delinquencies, collections, asset quality when it comes to MSME business loans originated organically versus once originated through